What's up, everybody? Welcome back to another live edition of the Multifamily Wealth Podcast. Joining me is Phil MacArthur. Phil, I think you were on the show 3 years ago.
About 3 years.
So technically a repeat guest, although a whole bunch has changed, I'm sure, in the last 3 years. Probably a lot of similarities as we'll get into, but I know a lot's changed. And I think in that first episode, we spent a lot of time talking about, your work as a broker in Boston, why you started buying in New Hampshire, but we're going to get into all that again and go a little bit deeper. So why don't you start with a quick refresh for everybody? How'd you get into real estate? Where do you live? How'd you find the business, and what are you up to today?
Yeah, absolutely. Thanks again, Axel, for having me on. It's been a couple years. Glad to be back.
Yeah.
But just as a little recap, I'm a real estate broker in Boston. I grew up just north of the city in Rockport, Gloucester area, and went to college in downtown Boston at Suffolk University. I got into real estate on the brokerage side, like I mentioned, but really got caught up after playing a year of Division III college basketball. Worked with a real estate broker that connected me with some other younger guys. It was kind of like an office, like Wolf of Wall Street at that point. And that was my first introduction into the industry. From there, I started doing rentals downtown. As you know, living in Boston yourself, great market to really kind of grow a business, especially at the time that I did in 2013, 2014, where the city was kind of going through a large growth period like New Hampshire has the past 2 or 3 or 5 years now. From there, I started a real estate team and started investing in real estate. And that's how you and I got connected, of course. I bought a 3-family in the town that I grew up, purchased that at $370, sold it at $720. Did a cash out refinance in between, and then moved my portfolio out of Massachusetts just because there's so much capital there. And I thought that New Hampshire had the largest growth opportunity, and 1031 that into about 20 apartments in New Hampshire.
3 in a building into 20 apartments. That's like, they're geographically close, but they're very different markets. And specifically, just again, this is my knowledge of where you've bought deals, and we're going to talk about it. Like, you went pretty far north. I think a lot of the Boston guys or the Mass guys, maybe they got their 3-unit in Southie or in Medford or whatever, close to the city. Maybe the owner occupied or they bought a rental. They sell. They want to go like 45 minutes north or an hour north and be in a big city. And you were like, we're really heading up 93. So talk about like where those 20 units were and like why you kind of bought in the area that you did and describe that deal a little bit.
Yeah, and I went way up there, up 89 even.
Yeah, this is the boonies is the easy way to describe this.
Right.
Yeah, people think New Hampshire's the boonies, but like this is the boonies within the boonies.
Yes.
Yeah.
So the first building I bought was an 8-unit off of Lake Sunapee, which is a highly desirable second home location in New Hampshire. And there was a 8-unit apartment building at the time that I purchased for $350,000. So what drew me to that type of property was 2 things. One, I had a friend that had a lake house and we'd play golf up in New Hampshire there. So I used one of the units for myself.
There you go.
But then also was the affordability aspect. Buying 8 apartments that were grossing rents at that time at about $1,000 a month. For $300
like per unit,
per
you're saying.
unit,
Yeah,
per
so
unit.
$8,000. Yeah,
yep, $8,000 total monthly rent roll at that time, and it was just the affordability aspect. I didn't think that it was going to appreciate to what it did, of course, but it was a little bit selfish that I, wanted a place for myself too. The other building was up in Farmington, New Hampshire. Now, if you're looking at a map in New Hampshire, I'm going, an hour and 45 minutes north of Boston, kind of northwest.
Yep.
To now as far east on the New Hampshire Maine border that you can.
You're basically drawing a big triangle,
big
more or
triangle
less.
where I was. And that was a 14-unit apartment building, so 22 units total that I purchased for 1.05. That was a little bit more of a stabilized asset that did grow into a little bit more of a value add and was able to kind of work through that deal. Do a full cash out refi within a couple of years and then redeploy that capital again.
Mm-hmm. How did you find those? So those agents, brokers?
I would say I now own I've transacted on 14 or 15 different multifamily buildings in New Hampshire. And I would say probably about 10 of them have been on market. I am licensed in Massachusetts, but also in New Hampshire. And that is one way that I have found all my properties is just going on the MLS and finding stuff that has, been sitting out there for a little bit, working with a seller and trying to either get them down or get them involved in the deal as well through a seller financing note, and just trying to figure out the best way to make it happen.
Mm-hmm. And so, well, actually, let's start here too. Like, what year did you buy that first one up in Sunapee in Farmington? That was like 2018, something like that?
Yeah,
or?
2018.
Gotcha. So at the time, I'm speaking personally now too, and I'm sure you had the same experience. Like, you could go on the MLS.
Yep.
Somebody would list a property, even if it was, Manchester, New Hampshire, which is literally exactly an hour north of Boston. For those who aren't from New England, it's, the largest city in New Hampshire. So this is where the bulk of the transactions are occurring for multifamily. At the time in 2018, like, you'd see a property listed for 80 grand a door, in Manchester. Now that same property trades at 160, 170 a door. As many markets throughout the country have seen, 2018 to 2026, like, a lot's happened. But at that time, like, you could buy a deal, quote unquote, on the MLS, and it would cash flow, and you could get it financed, and it had good DSCR, and it, made sense more so than it does today. Like, that was the dynamic at the time. And then you only, that dynamic was only more prevalent if you were looking in markets that were even farther outside or in more remote areas. So, at that time, like, that was certainly a strategy that worked, to go out there and find deals, right? You're identifying an inefficiency, and, like, these properties are grossing a ton of dollars. We're buying them at, this low price per unit. I mean, the Sunapee one is like 50 grand a door or something like that.
If that, yeah.
Yeah, it was less than that. So, but the other flip side is, okay, probably less, slightly less tenant demand, probably, now I'm just making assumptions. You can correct me if I'm wrong, like slightly lower class of tenant on average. Yeah. And then the management piece, right? You're living down in Boston. You're working as a broker, as an agent. You're doing deals. You have a, let's just call it another job. You've got something that's calling you and making you work Monday through Friday, even though you might be able to set your hours. And you've got these properties that are between 90 minutes and an hour 45 away. What did that look like early? Like, what were your systems early? Did you, just always want to self-manage early? Like, how did that all come to be?
Yeah, to start, it was definitely chaos at all times. My life felt that way. From managing the apartments to also then selling. It was just constant chaos that I was involved in, which, who cared if I owned 25 apartments at that point? And I was dealing with that on top of what I was already dealing with within the industry. Mm-hmm. I had set up, of course, like online payments, e-signatures, everything along the lines of that. But I would drive up at 10 a.m. to go show an apartment in Sunapee, New Hampshire.
Oh my God.
Grab a extra large Dunk's coffee and make my way up there to then also be back in the city of Boston by 12:30 to go do an open house at a $3 million listing.
I just got nauseous.
Yeah, right. And I did that far too long. And that's one of my kind of biggest regrets, of course, was not at that time, I really should have outsourced management. But I was really trying to bootstrap as many deals as I possibly could and take as much as I possibly could to roll into the next transaction. Mm-hmm. In hindsight, definitely not the way to have done it, but that's what I had done. Yeah. And it is possible.
You're not alone. That's how most people do it when they start, right? I mean, like, that's what I was doing. I was living in East Boston, and I was driving up to Manchester at 8 o'clock at night to meet the carpet guy. Like, that was like my triggering event to get out of it, to no longer self-manage. It was like 25, 30 units or so. It was like, it's 10 o'clock, and I got stood up by the carpet guy, and I was like, all set. I was like, I think I'm good, right? That was my personal endurance for pain. But, like, as you described it, there are a lot of reasons to self-manage. And I think also there was probably a dynamic in those areas where it's not like you've got a ton of awesome PMs to choose from, especially back in like 2018, 2019. Right. Yeah. Yep. And I would imagine that probably played into it too.
Yeah, absolutely. I did interview a Sunapee PM up there, but they wanted, I think it was 8% off of gross rents. And, I was looking to scale, so I couldn't necessarily take that out of my bottom line every month. Mm-hmm. And I also still was self-funding a lot of the renovations. Yep. So I didn't want to give up a lot of that control where I knew that I could work with one plumber. He was going to charge me X, and there wasn't going to be an additional charge-up fee to that. Yeah. So really, kind of controlling everything. It isn't the way that I would recommend doing it to somebody looking to get in the industry now. Mm-hmm. I would definitely, to new investors out there, I think the playbook now would be, of course, to find more properties that you can truly add value to by adding units or square footage, but then also not self-funding the renovations unless you absolutely have that capital. Yep. But I was going out selling condos to then go fund my renovation. So that's one of the biggest takeaways that I kind of regret having done within building a portfolio now of 125 units.
Is financing more of the renovations, and maybe, I know you mentioned too, like before we got going, like, maybe raising capital would have been a part of that too, and not relying on your own dollars to, to just continue pouring into the deal, one, to buy, and then two, to fund the renos.
Yeah.
Like absolutely. If you were to go back, like tactically, would you have like looked to find like a business partner maybe to help raise it? Would you have, syndicated? I don't know if you've raised capital since, or if you're still 100% solo, but...
Yeah, I haven't raised any capital, so I am still solo, but doing it in a smarter way.
Yeah.
If I was to be buying my first property looking to buy my next property in the next 6 to 8 months, I'd be looking to bring on a partner or an investor that can help take off some of the load of myself financially to be able to scale and grow faster.
Yeah. And I think what's interesting though is, and I would say the same thing, like I didn't work with investors either until I probably a similar trajectory. I've got to like the 80 doors or whatever before I raised any money. But it was like, it was a lot of debt. It was a lot of stress and money across tons of different projects. And then sometimes those projects hitting a wall because the money's not there to continue doing the next unit or the next phase of it. And it's like, you got to refi this one over here to roll the money into that one over there. That's how a lot of people do it. I think that's like how I'm speaking broadly, but like the majority of like the kind of deal-oriented real estate guys who don't come from like the institutional real estate firm, and then their only exposure is like, oh, we raise capital to go buy this stuff, and then they go and raise capital to go buy their own buildings, is like you're probably trying to like bootstrap and get a few under. But I would agree. I mean, I think a big lesson for me is like after you've done 4 or 5 deals, like you probably have a good enough sense of what the whole process looks like to go and bring in some capital and feel comfortable about it. And that does alleviate a lot of the stress around it, while also obviously letting you grow faster. But it seems like you had a similar experience with like, got to get this, deal closed down in Boston to go and get that commission check to go pour it into the next 3 unit renovations or whatever it would have been.
And it creates a lot of imposter syndrome.
Yes.
Even still to this day, where I was doing all of this and I didn't necessarily know exactly what I was doing, whether it was right or not. And I think, now where I am, I kind of see back that I did it okay. Mm-hmm. I could have scaled and grown faster, but surrounding myself more so in the past 3 or 4 years with people like yourself, we're at the Vault, Mike Ketchens, like all these other people that are investing in markets that we're in, kind of helping validate what I did was okay, but then also really kind of helping me to take my game to the next level from a management standpoint, which was my biggest bottleneck within my portfolio, I would say.
Yeah. And, you went from the 22 units, you have the 8 in Sunapee, you got the 12, or the 14 in Farmington. Yeah. I know you did a handful of deals after that of kind of similar size, and maybe there's milestones along the way where something clicked management-wise where you brought somebody on, or you got much better at a particular process, or like you found the right GC. Like, what were some of the key kind of things along the way that made management a little bit easier as you continue to grow? Yeah,
once I got to about 75 units, having probably at that point 100 tenants, in a lot of Class C, even Class D stuff within a lot of these markets that aren't necessarily in the highest demand, or have the best tenant prospect, I would say, for me at that point, it was, okay, I can't keep showing up to these showings at 8 a.m. on a Saturday and getting no-showed. Right?
Yeah.
Like that was...
That specifically, it's the no-show after driving a while that really, really gets you. Yeah.
Absolutely. Yeah. Where I then had, bought enough buildings, started networking even more, and I had a tenant that had worked for a larger real estate company in New Hampshire and was one of their, like, kind of handy people. Cleaned and did a lot of tenant communication, and I took her on, and she's really kind of been my saving grace the past 2 or 3 years, which has allowed me to step back, focus on how do I, make my portfolio a little bit of from a cleaner on a financial standpoint, and she's going to deal with this person's looking to take on a new cat in their apartment and deal with that, or we have 2 vacancies coming up, do the walkthrough with the previous tenant, get the security deposit back. It's freed me up a lot to be able to take it into the next gear.
Yeah, so she's kind of operating as like a generalist property manager who's, I'm going to do a little bit of leasing. I'm going to, take some calls, from tenants who I want to have a roommate. I'm going to go and help people move out, kind of handling like all the stuff that maybe requires you to be physical up there. Like she's kind of taking on all that.
Yeah, I tell her that she's the cork in the bow of the boat.
There you go.
Instead of water keeping coming in and hitting me, she's the one that kind of is dealing with a lot of that. And I wish I had done that when I bought like 35 units.
Yeah.
I think that was the time to actually scale to that point instead of keeping it on for another 2 or 3 years.
Yeah, but I think that's kind of the magic number though for a lot of folks is like whether it's 35 or 50 or 75, like generally speaking in that broad range, like you could probably get to 75 if you've got like all really nice. Newer A-class buildings that were built 20 years ago, 10 years ago, whatever it might be. But if you've got 100-year-old buildings in remote areas in New Hampshire, like, yeah, maybe that is 35, right? But whatever it is, like that's the best first hire is somebody who just kind of deals with a lot of the stuff and has like good soft skills and is like a generalist versus like one kind of narrow specific person. But tools and software that you picked up along the way or maybe that you use now where you're like, couldn't live without it, I'm sure you've got like a property management software or something like that.
Sure.
But like, even outside of that, like anything specific that's really helped you get your arms around the whole thing?
I'd say, 2 big things was a change for me. Getting onto DoorLoop. I don't know if you're familiar with that. Shout out DoorLoop. But,
no free ads. We're going to hit them up after this.
No free ads, exactly. But they have been super helpful. That whole platform has been super helpful. Just managing tenant, payments, who's behind, even just putting together reports for me as a property owner to get over to the bank when they request it, rent rolls, and all of my maintenance requests now, I've gotten all my tenants to go through that portal, put everything in there, it gets sent over to her, and she facilitates now with the plumber or the electrician or whatever needs to end up happening. I would say that's the biggest one for me. Obviously all online ads and things along the lines of that. I don't do any direct outreach to sellers looking for deals, which is, I know, kind of how most people are finding their best properties that they end up purchasing. I'm still kind of, just directly working with agents that I've built relationships with over the past now 8 or so years.
Mm-hmm. But I think that makes a lot of sense in terms of where you're buying, right? Because the direct-to-seller thing, obviously we do a ton of direct-to-seller. It's a core part of our business. We do that, but we also still work with the agents and we still work with, the investor who runs across a deal but does, timing doesn't work for them, so they want to just refer it over to someone. Like, we're still kind of doing all of those different things. But in the competitive markets, that's where we've spent more time doing direct-to-seller, like the southern New Hampshire markets of like Derry and Nashua, Dover and the Seacoast, like where there's not like a lot of out-of-state interest in those towns from a deal standpoint. As you head farther north or you head farther east, or not really east because you got the ocean, but farther west in New Hampshire, and it's less competitive, like you can have a good relationship with a local broker out there who just wants to get somebody on the phone who like owns in that area and can close. Because at the end of the day, like trying to get the out-of-state guy, which ironically was like you in 2018, but usually that's a harder sale to make, is like the guy who hasn't done anything in New Hampshire going up and buying 14 units in Farmington. Like usually they kind of want to be in the more populated area. It feels safer. It's probably a little easier to get financing, all that stuff. So I have to imagine like you've become, kind of entrenched in the local area up there in terms of like the brokers that are doing those deals and all that, just given the fact that you own a lot up in these general areas now.
Yep. Absolutely.
So after the 22 units, I want to just, kind of quickly talk about like the thought process around, because I know you kept buying more in these areas. Was there ever a thought like I want to head farther south closer to home, or was it always like I want to be in these more, smaller town, tertiary areas, kind of more podunk regions of New Hampshire?
So for me, it was, again, going back to the affordability of what I could buy. I didn't foresee what was going to happen in 2021, 2022, but, reap the benefit of that, right? And now I'm actually selling out of those markets and buying into, larger Class B properties, using 1031 exchanges to be able to take that capital or cash out refis of properties that I see myself holding for a longer periods of time, and redeploying that capital back into a larger, more stable market and a more desirable property for the long term. Yep.
At the time when you're buying these buildings up there, like from a financing standpoint, How are you getting them financed initially? I'm assuming that you created some value, or the market continued to gain steam as it did, and then you refied. Like, availability of debt up there, you working with like local banks, credit unions,
all
folks
local
like that?
banks and credit unions within those markets. So, for example, Sunapee, there's a bank just off of the lake there that had used, and this is one of the key pieces I think that actually helped me close a lot of these deals, was working with local banks that already had the existing debt on the property. So they were already familiar with the property, and that's all public information to go look up, or even just ask the seller's agent when you're going to view that. That was, I think, something that a lot of other banks wouldn't have looked at to buy. But I did create the value, went in, updated most of those units, and now I'm selling a couple of them, like I mentioned.
Yeah, no, I love that. I mean, I think when you're in an area that doesn't have like a lot of, for example, there's not going to be many like Northern Mass banks or credit unions that probably want to go and finance the deal in Farmington, but they would maybe go and finance the deal in Southern New Hampshire that's, 30-minute drive time away, or just in a more densely populated area where it feels a little bit, less risky.
Yeah.
But in those areas, you do have those like very hyper local 3, 4, 5 branch banks or credit unions that are like, we really want to invest locally, like in the local community, and put a sign up on the front or something like that says, hey, we finance this building. Typically that's a development versus a value add, but like same concept. And the easiest way to find them is just go look at who has the loan probably on the deal that you're buying. Right? Yeah, exactly.
If they've already had that loan for 20 plus years, buying from a small mom and pop, they're probably going to want that again, because they don't already have, they're not pulling in a ton of business all that often. And I did find some, reasonable terms that I, was happy with.
Over the years, how has your time investment, and maybe it hasn't changed, but how has your time investment, changed or focus changed as it relates to like brokering deals in Boston and selling the condos and selling all the, the single families around Boston versus like growing the portfolio up in New Hampshire? Has it kind of been the same since you started, or has that changed?
I'm starting to, I'm not as young as I was back then in willing to spread myself so thin. Definitely with my time, I'm getting a lot, more honed in with what I want to be doing. Mm-hmm. The brokerage side of things is a great way for somebody that wants to get into either real estate development or multifamily long term, just to understand how the lingo works between brokers putting deals together, but then also how to find deals and how to actually execute. The brokerage side in Boston's, a great market. It's changed a lot since 2021 from being in a smaller or slower market, but it's a grind being in sales. I love the multifamily game, being able to go in, find a property that has some type of value add, whether it's adding space, bedrooms, or just strictly cosmetic upgrades, where a seller is tired, has rents at $1,600, where market's at $2,100, right? Like that's just creating value. And as long as the box looks pretty good, it's kitchens, countertops, appliances, LVP flooring, which I feel very comfortable being able to do. So I've shifted most of my time in my just my focus, I suppose, to wanting to continue to grow my multifamily portfolio up here.
Yeah, and I would imagine it's as the deals get a little easier to run, and you can manage more units with one person or a smaller team if there's more people at some point, like. It's you start making more money across more of these, from a nominal dollar amount standpoint. Probably gets a little easier to replace some of the work you're doing on the brokerage side. And I mean, outside of that too, I think if you're going to be buying closer to home, you probably increase your bandwidth. Closer to home being Boston versus going all the way up. Not that you're physically heading up there, but you probably still physically head up there to go look at a property during a walkthrough or do inspections or what have you. Generally speaking, like long-term objectives for you, like multifamily wise or buy and hold wise, I think you said 125 units, right? It's current portfolio. Yep. Like, is the goal to grow a large business vertically integrated? You've got hundreds and hundreds of units with like a big staff, or is kind of, you want to maintain the lifestyle design of, I'd love to broker some deals, maybe 20 hours a week versus 50 hours a week. Buy some rentals and, kind of keep my arms around the whole thing.
Yeah, so I was working, and I really got burnt out from working in Boston with like a large national brokerage. A lot to it. You get a lot of people coming at you for a lot of different things. I started my own brokerage. I just do my own deals now. But what I mean by that is working past clients, referrals, friends of friends. It's taken a lot of stress off of me. And I've enjoyed the selling process more than I did in 2021 and 2022. For multifamily, where do I see myself? I have 3 properties under contract that I'm doing a 1031 on and looking to identify hopefully a Class B garden style 1970s or so build. And then what I've bought over the course of the past 2 or 3 years, I've added the value within the past couple of years within that time frame and looking to start to do a cash out to then redeploy back in probably like 2028 at that point.
Yeah.
Rates are still a little bit elevated. I was buying deals and I bought, my best properties that I've been buying have been with higher interest rates. Some of them have debt at 7.25%. Hopefully we can ride down the rates a little bit longer where I can take a little bit more of the cash out after having added some value, and then continue to look to buy in more central markets like Manchester, just around there, or closer to the seacoast, southern New Hampshire, and buy stable properties with a lot of separate utilities. That's one of the other things. And a lot of these like Farmington, Sunappees, is you don't have properties that have gas heat. So you're dealing with a lot of oil up in the Northeast, right? And that is a variable that you don't necessarily know what's going to exactly look like at the end of the year, where now I think in New Hampshire, you start getting into these Class B properties that are newer builds, and you have that, separate utilities, all gas, but probably still on some type of septic, right?
Yeah. Yeah, it's interesting. I mean, it's like once you go up into, the Farmingtons of the world, or the Sunappees, or, Pembroke, New Hampshire, or Tilton, or like all these towns that are small towns, out there, like it's not uncommon to see a 6 or an 8 unit building that at one time was just one big, like massive single family home. And then, maybe this big, like 6-bedroom house. And then over the years, they've chopped it up and diced it up into 2 studios and 4 1-beds and this random 2-bed. And yeah, it's multifamily, but, maybe there's 2 electric meters for 6 units and you're paying the electric. Or even if it's separate electric, you've got the one heating system, and all it takes is, one of the tenants living there will just leave the window open for a weekend, and next thing you know, your whole year's shot, right? I mean, it doesn't take much.
No.
So it's interesting, and it's not a problem, I think, that many folks, because there's national folks listening to this podcast, where it's like if you're in Florida and you're buying your very cookie cutter 1980s concrete block, it's all just, we've oftentimes got a water meter heading into each unit. Yeah. Like you're submarine in the water easily, and there's no utilities. Where that is an interesting dynamic that we have to manage in New Hampshire, but it sounds like you're just looking at different deals where that's not a concern.
Yeah. Now, I think that's one of the interesting things about New Hampshire, right? Like that, I view that almost as a Class B building.
Yep.
Where in a lot of other markets, like I know you had invested down in Florida, is that more on like the Class C-ish type stuff?
Yeah, I mean, like unless you're in that really nice geographic location of like a good neighborhood in like Tampa or Miami or whatever, and a 1980s building is Class B, but like most, the vast majority of the state, if it's built in the 60s, 70s, 80s, like it's a Class C building. And it's like if I see something built in the 70s in New Hampshire, I'm like, we got a new build here. This is nice. Yeah, this is good stuff. Look at this vinyl siding. It's beautiful. But it's interesting because it just demands a different approach in how you underwrite it and how you operate it, right? It's just because something is built in the 1970s doesn't mean that the building itself is functionally, trash, right? Like that's not really the case, because the rental market in New England is a ton of early 1900s built galley kitchen, like, weird living room, just kind of functionally obsolescent stuff. So something that was built in the 70s is actually very functional because it's, a little bit more modern.
Yeah.
Whereas that's not the case in a lot of other markets, which is very interesting.
I think we benefit, of course, being in the Northeast, being in a little bit more of an isolated market where we have more, I think less inventory overall as a whole in the meds and eds, which is down in Boston with the education and, the pharma whole industry, where that all bleeds up into New Hampshire, which I think just insulates the market a little bit better, where we don't see those large fluctuations that a lot of investors are seeing nationally, whether in Arizona or parts of Florida right now. I would say that we haven't really seen much of that.
No. I mean, I think broadly speaking, people just assume that everywhere, meaning every geographic kind of market or area within the country's had some level of distress over the last few years. And it's like, there just has not been distress in New England. Yeah. It's funny, earlier today, and I know, I believe Pat Brady, who, debt broker, we recorded an episode earlier today, and he jokes, he's like, I get 2 calls a week from guys who are like, which banks are like struggling right now, who've got the bad loans, and it's like there's no distress. Like,
doesn't happen.
No, like here, unless it's like office, right, or something. Right. But for multifamily, it's like the rents have kind of flatlined. I think in New Hampshire, at least, I want to talk about a market I know, which is New Hampshire. The last 12 months, 18 months, it's like maybe in some areas you've got little 1-2% rent growth. Some areas you kind of 1-2% rent declines. And there hasn't been like a lot of real actual rent growth. Right. But expenses haven't gone as crazy as they have in many other markets. Like insurance is kind of relatively similar. Our utilities are relatively similar. And cost of labor maybe is going up. But like we're not seeing like the insurance, 2x like it has in Florida and all of these other markets where, the P&L is also kind of getting hammered along with the fact that people structured the deals wrong from a capital standpoint. So New England, I think, is interesting in that respect, where a lot of people have been able to play like offense the last few years, right? And I would just, you being a good example of like these buildings that I bought in these, very small markets have still appreciated significantly in value. The rents have continued to increase. I'm selling them at these really compelling prices, and I've been able to keep buying, which I think is, not a dynamic that every market in the country has been able to kind of capitalize on. Yeah. Now, in terms of pursuing deals now, we're going to talk about a deal in the deals segment where we kind of really dive into this, but generally speaking, like what sticks out outside of being, maybe Class B, Southern New Hampshire, good area, like what type of value add deals are you looking at? Like what's kind of the story of what you're looking for from like a deal standpoint? Is it still kind of, we're just looking for light, moderate value add stuff and we're going to create some value that way, or are there other little things that you like to see when you're looking at a deal?
Yeah, I would say that is probably my main focus right now. Yep. I feel, like I got burnt out in 2021, 22 selling real estate. I feel a little burnt out right now of doing a lot of the value adds, adding apartments to buildings, and turning over probably 20 to 25 units a year the past couple of years. So I've kind of hit that burnout point where I am still within the business, more than probably like how you're in your business, but something that I can kind of go in and just do a light cosmetic would be really great. Hard to find, right? And it's not going to look all that sexy on a pro forma, but I think with where we are in the market and my belief of New Hampshire multifamily, I still don't think that we can go wrong with buying up here. Yeah. If it's a Class B building and I can buy under replacement cost, I think that's probably a little bit of a win for right now.
Yeah, I would agree. I mean, it's also, we also really like the light, moderate value adds. Our whole thing is like we want to be paid for our knowledge versus swinging a hammer. How do we optimize the operations and some pet fees, some, garage rentals, maybe a storage unit or two, maybe, finishing some attic space that's unfinished, where it's like the little light lifts that create the outsized value, where it's more of our know-how that's where we're earning the dollars versus like we're going in here and we're just gutting this apartment and taking on all the risk that comes with gutting the apartment. Yeah. Last question before we wrap. I can only imagine that it was probably challenging to find consistent help to renovate apartments where you were buying them. Like, did you end up finding like a good crew or two that you just kind of kept sending back in, or like, any war stories from that stick out? Oh yeah. And still wear a lot of those bruises. Yeah. I have, as I was scaling, I would just use still a lot of my network out of Boston, and there is a crew of guys that lived in Revere that were willing to go drive 2 hours to go work for me. And I think Godspeed. Yeah. And they got me to where I kind of am now, to a mostly stabilized portfolio. Yep. So I still use them. More recently, I've brought on somebody, to work for me for 4 days a week. He goes and does 2 other days with another property owner in Southern New Hampshire. And, he's just doing whatever I need. There's definitely times where there's, probably paying him, and he's not doing all that much other than just kind of tightening up loose ends on certain properties. Yeah. But having that guy now that I can call, or really at this point Cheryl calls, to go deal with any tenant issues or
the leak at 10 o'clock at night is huge for me.
Yeah, well, you kind of, 125 units at that point, you kind of need somebody who's on call, more or less, at least some percentage of the week. And even if, he's not working a full day and you might be paying him or whatever the structure is, it's like just having the speed of my water heater isn't working. I need somebody to go look at it. Like, instead of trying to coordinate with a few different vendors who are all over the place, just having someone you can send is like good tenant satisfaction, I would imagine.
Definitely. And I think one of the keys to my success is tenant retention year over year.
Yeah.
I think, I have probably 90 or so percent retention, which I think within the industry is, high.
That is high,
right?
Yeah.
The past couple of years, we've seen rents kind of level off, so there hasn't been any crazy jumps in rent that I've been looking to get. So people have been staying, but that's one of the big things that since having Tyler has really helped me kind of keep people as well.
Yeah, which is good. Yeah, that's at the end of the day, like where you make all your money. It's like, do you retain tenants?
We are right. We are in a service business. I still feel as landlords, like depending upon how hands-on you are, you have to provide some type of service to your tenant, and they are kind of your client at the end of the day. So. And then I had gone through all of those, years of losing tenants year over year. Somebody's only there for 12 months or whatever, and then leaving. And I think a lot of that was because I was waiting 2 to 3 days for a plumber to show up in, Sunapee or Greenville, where there are only a handful of plumbers, right?
Like literally, there's like 5 or 3 or whatever the number might be. That's like the number one reason, like outside of. So I guess maybe it's not the number one. But number one is lifestyle change. You need a bigger apartment, moving out of town, whatever. But like number 2, and the industry says this, like if you all the surveys that NARPM does, like the National Association of Property Managers, it's like crappy maintenance response. It's like I didn't have hot water and I took cold showers for a week. Like I just don't want to, even if I know moving is going to cost me money and it's economic waste in my life, I just don't want to continue renting from this individual because I don't like them. Like that's a real dynamic for sure.
Yeah, and I think being landlords, we get a bad rap right out of the gate.
Yeah,
right?
Exactly.
So regardless of how excited somebody can be moving into their apartment, if you have issues within the first 30 to 90 days, they're probably already made the decision that they're probably going to end up moving out.
Yes, 100%. All right, man, this has been great. Appreciate you taking the time. Where can folks reach out to you, learn more about you?
Yeah, so I'm just on Instagram. Windrift RE is my little handle there. It kind of showcases what I got going on in and around the city and then what I'm doing up in New Hampshire. Always happy to grab coffee with new investor, local investor, somebody looking to do a deal. So, yeah.
Love it, man. Sounds good. Well, thanks again for the time.
Yeah, appreciate it. Thanks, Axel.